All right, folks. So welcome to Investing for Beginners podcast. Today, I thought we would do something a little different. We are going to take some quotes that our friend John Rotanti put together, a collection, and we're going to talk about some Buffett quotes, and we'll read them on the air, and then Andrew and I will kind of go back and forth on what our thoughts are on those and how we can learn and become better investors from these quotes. Buffett is the master, and most of these are coming from his shareholder letters. And I think there's one quote from an interview he did on CNBC. So full credit goes to John Rotanti for finding all these things. Andrew and I's thoughts are ours and ours alone. So let's start with an easy one. So what Buffett kind of looks for when he's looking for his pot of gold, if you will. So his goal, he says, your goal as an investor should be simply to purchase at a rational price a part interest in an easily understood business whose earnings are virtually certain to be material higher 5, 10, and 20 years from now. And this is from his 1996 letter. So how does that strike you, and what do you think of that quote?
A couple things that kind of jump out the page for me is he says earnings are virtually certain to be materially higher. That's one of those things that would exclude a lot of businesses from your list.
A lot of businesses.
Business is not that certain. So that makes stock picking really hard when that's your criteria.
Yes, for sure. It does. And if you think about the companies that he has bought along the way, in hindsight, you look at that quote and you look at the companies in hindsight, and it makes sense. It connects the dots. Gillette, Dairy Queen, American Express, Coca-Cola, Steve's Candies, BNSF, the railroad, the insurance businesses that he's bought along the way. All those would definitely fall into those camps. Companies that you notice that are excluded from that he has not bought, that he wasn't able to wrap his brain around: Amazon, Google, for example, or Alphabet. Those two kind of jump to the top of the list of companies he doesn't own that are not part of that list, that he didn't feel like he had a circle of competence on. I find that kind of thinking and quote really intriguing. And I think that's one of the things that you try to do, is you work really hard to try to find companies that have predictable earnings. And you might say are air quote more boring, if you will, but I think there's a lot of strength in that.
If you're a beginner, why is it this way? Why are so many businesses actually there's not that kind of level of certainty that they will grow by a lot over the long term?
If I had to hazard a guess, I would say there's probably a few things that kind of jump to mind. Number one, depending on what industry they're in, it could be super cyclical. It could be that the product or service that they offer may not be as strong of a moat as you may originally think. It also could be that the technology that they are using is very easily replicable, and so it's easy to breach that moat very, very quickly. And I think that's one of the reasons why he has probably stayed away from tech, is because it can change very, very fast compared to something like ice cream and Dairy Queen or razor blades for Gillette. The disruption that comes for those kinds of industries is probably a lot lower than it is for something that's tech related. Think of semiconductors or laptops or security or AI, any of those things. There's a ton of competition, and the disruption potential, I think, is much, much higher in those industries.
Well, just look at how fast NVIDIA grew. I've seen charts on Instagram showing the time it takes for certain tech platforms to get a certain number of users. I don't know if it was hit like 1 million users or something. You just see these exponential charts, and it's like what used to take years to reach a certain scale. I can't remember what the numbers were for ChatGPT, but it was at less than 100 days or something. They got to the same scale as Instagram took 7 years or something. I don't know what the number is, but it's truly extraordinary.
I saw the same chart, and it was kind of showing the evolution of how quickly technology is moving and how quickly some of these platforms get adopted compared to what it was like even 5 years ago. And then if you look 10 years back, it's even a slower rate of adoption. So yeah, the rate of adoption for these things is accelerated tremendously. And that's one of the things, if you kind of tangentially think about that, it's one of the things that concerns me about Uber is what's going on with Waymo and how they're starting to pick up the pace of acceleration of starting to offer their services in more and more cities. I'm not saying it's going to happen overnight, but it certainly could be one of those things where you think it's going to happen and all of a sudden it's here. It's like, whoa, okay, that was fast.
It's a lot easier to download an app, to get people to download an app than it is for you to open 1,000 new ice cream stores around the U.S.
Right. Yeah. Yeah. Way easier. Or, to find the next greatest underwear brand or something. I think he owns Hanes too. So, it's just, those kinds of things are a lot harder and slower to disrupt.
Hey, those are fighting words, man. You're calling Hanes best underwear. We're going to have problems.
I don't think I don't have a dog in that hunt. I literally wear whatever my wife buys me. So
that would be some podcast content, huh? A fiery debate about men's underwear.
Right. Fiery debate. Fiery. All right. Let's move on to the next quote we can discuss. So this is kind of Buffett's thoughts on his ideal holding period. So he says, we are quite content to hold any security indefinitely, so long as the prospective return on equity capital of the underlying business is satisfactory, management is competent and honest, and the market does not overvalue the business. And this is from his 87 letter, which I would argue is probably one of his top 5 or 10 letters that he wrote of the 50, 61 that he's written. So what are your thoughts on this quote?
It's so simple. And if you can prescribe to it, and it takes a little bit of like persistence or perseverance of having conviction in your ideas. But if you can really stick to it, it would simplify your life so much. Because I think a lot of investors, myself included, I can fall into this trap and hopefully rein myself in. But it's like I want to think about a lot of different companies in my portfolio. Like, is this the time to get out? Is this the time to sell? Do I sell high here? But if you listen to this quote, it's not about selling or getting out. It's about earning a return on the capital. And that's a completely different conversation.
Mm-hmm. Yeah, it really is. And he comes back to that over and over and over again. It's a common theme throughout all of his letters, as well as his shareholder meetings and any interviews he gives. This is definitely part of his mantra, is looking at that return on capital and how he can grow that over a long period of time. To your point, these are very air quote simple rules. Doesn't mean they're easy, because in most cases we are all smart enough, IQ wise, education wise, to pull these off. But the challenge is the mental part of it. I think that's one of the underrated parts of his investment style, is not only the patience, but also the mental capital that he has to be able to understand what he's trying to do and stay on task. We all get distracted by the shiny object, or we get distracted by more recent news, and the air quote noise can throw us all off the path quite easily. So the challenge is to stick to these simple rules and to stay on the path, and not to get emotional about these decisions, and just try to focus on the return on capital. And I think if you do that, it kind of helps filter away some of the things that we can get distracted by so easily.
I get tempted sometimes to just say, man, what if I just sold everything and just had 4 positions? Does that thought ever cross your mind? Is that just me?
On occasion, I have thought of that, and then I get scared and think, well, I don't know, I don't feel like I know enough,
Right?
To have that level, that Charlie Munger level of conviction of owning 4 businesses and not really caring, literally till the day he died.
Yeah,
That's what he did. He didn't care, and he was happy. I think some of it comes to, he had enough. And so I would hazard, if you have enough, then your attitude probably changes too. Like, what's an extra billion? I mean, big deal.
right.
I already have more than I could ever spend literally in my life. And so what does it really matter? It's at that point, I would suspect that it's more about the game than it is the actual money.
It is interesting that the context of Buffett, how he buys stocks, he's doing it for Berkshire Hathaway.
Mm-hmm.
And so he feels that pull to kind of chase those shiny objects. But he's determined that the best path for him and Berkshire is to just have satisfactory. It's interesting, he doesn't use maximal or optimal or any of these productivity buzzwords that you hear these days. It's satisfactory. And that takes a lot of, to your point, discernment of what's enough for me and what's enough for Berkshire. And if people don't want that, then hey, the door's open. You don't have to be a part of this. And I think that's part of their secret sauce, actually.
Mm-hmm. Yeah, I would definitely agree. I think the other thing, and I kind of touched on it too, is the patience that he has, the willingness to not do anything. Mm-hmm. It's a decision and it's an action, but most of us always feel like we have to be doing something all the time. And whenever the market has gone through turmoil, there's always lots of speculation that now is when he's going to, air quote, bring out the elephant gun and, make some huge purchase. And inevitably he never does. And he gets a lot of blowback in the finance world because he doesn't, he's lost it. He doesn't blah, 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 all those different things. But I would argue that that's probably when he's showing his brilliance the most, is that he's showing restraint and he understands who he is, what he's trying to do. And he's not just going to do something just to do something.
Yeah. Oh, for sure.
All right. So let's move on to the next one. And this one is a little bit about valuation. So he says in his 2009 letter, Charlie and I admit that we feel confident in estimating intrinsic value for only a portion of traded equities, and then only when we can employ a range of values rather than some pseudo-precise figure. So how does this strike you, and what are your thoughts on this?
Super profound. Here's a little tidbit too that you have in our notes. He wrote this in 2009. So this is a guy who's been buying stocks since at least for other people as partnerships or part of Berkshire since 1965. So what's the math on that? 55 years.
Yeah.
He says they estimating intrinsic value, which is what the entire stock market's trying to do all the time. Mm-hmm. And the guy who's been doing it 55 years, who's the GOAT of investing, he says we can only do it for a portion of equities. There's a lot of humility there, and I think there's a lot of wisdom there.
Yeah, for sure. Whenever people talk about valuation, he has never, to my knowledge, revealed exactly how he values companies. He's thrown out lots of hints of different things here or there, little tidbits and whatnot, but he's never specifically come out and said, this is how Charlie and I do it. We look at this, and this is how we value the companies. And Charlie's even said in his way that they don't use any of the formulas or gobbledygook that's taught in schools on how to value companies. And they've talked a lot about this idea that the value should jump off the page at you by just looking at the numbers. And if you have to use spreadsheets, then it's maybe not the most obvious thing in the world. Buffett is certainly, and I think I've said this before, Buffett has a computer-like mind. And even though he may not do DCFs in the way that Andrew and I do them and other people do them, he certainly is doing that kind of work in his head, and he can figure that out on his own. And as you said, he's been doing it at this point. He had been doing it for 55 plus years. So he had a bit of experience figuring all this stuff out. I think the thing that I like about it is that he defines that he's looking for a range of values rather than some specific number. And I think that's one of the things that when people talk about valuation, they get bogged down in the final number as opposed to what are the range of values you should be looking for, because nothing is certain in the market. And when you're trying to value the value of a company, that's based on the numbers you're looking at today, and those are always changing. And so it can't be a precise thing. And I think also if you're going to get bogged down in the minutia of I'm only going to buy Berkshire Hathaway if it's trading at $382. If it's $384, forget it. If it's $390, forget it. It's got to be 382 or I'm out, kind of thing. And I think that is a very short-sighted way to try to value companies. And I think this idea of having a range of values is a much, much better way to give yourself some latitude on what could be wrong in your estimation of the value, because again, it's not precise, and if you're using a DCF, you're using estimates, and so it's not going to be exactly right, even though it's very mathematical. So I mean, I love this quote.
Me too. Having to think of a range kind of forces you out of your biases for a minute. You have to consider, what if I'm wrong? Because you're putting a number in that's hopefully, whether you're playing for the worst, hoping for the best kind of thing, but you're having to make explicit what that maybe not worst case is, but more bearish case. And lots of different great thought leaders have kind of said the same thing in different ways. Manish Prabhai, heads I win, tails I don't lose much. Michael Mauboussin, have a bear case, bull case, and neutral case, and then average out the three. There's a lot of power to it for sure. Question for you: do you have a group of stocks, that industries, sectors, whatever, where you're just like, I am not confident in estimating intrinsic value there, and I probably never will? Do you have a bucket or buckets like that? Yeah,
I certainly do. I've said this before, and I'll say it again. Commodities feels like voodoo to me. I mean, I understand it on a certain level, but to have the confidence to estimate an intrinsic value for something like Chevron or Exxon or anything in the oil industry, forget about it. It's too hard piled quite easily. Airlines scare me. Flying doesn't scare me, but investing in an airline terrifies me. Auto industry, to a certain extent, definitely falls into that industry as well. I don't feel like I understand. I'm not a car person, and I just don't get that whole thing. And there are certain areas in the tech industry that I probably stay away from as well. So there's definitely those are two or three that popped to my mind immediately that I'm like, no, this is too hard pile for me. What about you?
a lot of the ones you mentioned, biotech for me,
Oh yeah,
I cannot.
hard
I
pass.
cannot.
Hard pass.
That feels like I would rather play roulette, because at least it's kind of fun to watch the ball bounce around. Just so many of those businesses fail. I flirt with energy. But it's a really hard place. It's like well, the number could be this if gas was here. If if the price of oil was here, then this company would be worth this much. But what if the price of oil was over here? And what if the price of oil is over there? And then my mind just starts getting all twisted up. There's other places too. There's plenty, but yeah, the ones you mentioned I think are pretty good as well.
Yeah. I don't understand them. And the cool thing about it is that's okay. You don't have to invest in those places, and the things that maybe I feel comfortable in or you do, maybe people don't want to invest in those, and maybe they figured out the whole commodity thing. They can invest in oil and natural gas and whatnot and feel super comfortable about it, and awesome for them. Right. And that's, I think, one of the beauties of the market is there's a lot of different ways you can grow your wealth, and it doesn't have to be exactly the way Buffett did it or the way that we do it.
Yes.
All right, so let's move on to the next question. So this is from his 2007 letter. So he said, long-term competitive advantage in a stable industry is what we seek in a business. Amen. What are your thoughts on that?
Yeah, I feel like the longer I invest, the more this seems to become important. Like, why didn't I grasp this right away?
Mm-hmm. Right. It's so obvious that when you see it, it's kind of like, duh, but it's hard to, I think, to me, it's one of those things you have to learn with experience.
Yeah. Even the whole concept is like a stable industry. Because it's a good point. You can be the leader, you can have great competitive advantages, but if your industry is being disrupted, those competitive advantages might not matter.
Right. Yeah, for sure. I mean, if you look at the semiconductor industry, I think that's a really good case study for how what appears to be a stable industry can get disrupted quite quickly. And you only have to look at Intel and what's happened to them over the last 5 or 10 years to see how it was happening gradually and then it happened all at once. And it looked from the outside like a very stable industry and that company had a very strong competitive advantage when in reality it didn't. And once it unraveled very quickly.
Yeah, that one's such a I guess that one's close to you and I because we saw it happen in real time.
Right.
That's funny. I feel like you were watching my notes as I was preparing for my write-up this morning, so that's funny. What about the long-term competitive advantage part? Do you think there is sometimes a difference in that between long-term and just competitive advantage?
Yeah, I think the long-term part of it, him being able to identify that is what sets him apart.
Mm.
I think being able to find a competitive advantage, I'm not saying it's easy, but being able to determine a long-term competitive advantage is kind of a next level. So if you think about American Express, I think that's a really good example of him being able to identify not only that the company had a competitive advantage, but that it had the potential for a long-term competitive advantage. And in hindsight, that has obviously played out extremely well. And kind of the same idea with Coke and probably to a certain extent Apple. And I think that's what set those investments apart from other ones that he has had and had success with. But those two, maybe three in particular, to me, really sets apart his ability to understand the competitive advantage and the long-term aspect of it.
Yeah, that's been on my mind lately. I mean, we talked about retail in a recent episode, and it's like just that difference between competitive advantage now versus something that's more structurally in place.
Mm-hmm.
To your point about Apple, Coke, and American Express, it's almost like the business itself generates the long-term competitive advantage, or the competitive advantage increases over time. So it's not one or two advantages they might have. It's not one or two, it's not the marketing division's brilliant, or it's not that inventory management is the absolute best. It's the whole machine. And as the machine grows, the whole thing gets better. It's so cool and it's so rare.
Yeah, for sure. And I think that also illustrates, we all talk about, I want to buy a company, I want to hold it forever. And that's always the goal, right? But I think it's only reasonable if the company has a long-term competitive advantage, because otherwise something's coming for it.
Right.
And it doesn't matter what the industry is. And so it's always a good aspirational goal when you go into investing in a business. Let's pick NVIDIA. And nobody knows if that company has a long-term competitive advantage. History tells us it probably doesn't, but how long that'll last, who knows? You can't. You could speculate forever on that. That could be a podcast or 6 alone. But when you think about the long-term competitive advantage of a business, I think that's what really sets those kinds of investments apart. And I think that's one of his superpowers, and that's one of the things that is the hardest part of trying to determine, does Costco have a long-term competitive advantage? Looks like it, but not sure yet.
Right.
I need to hold it for another 10, 15 years. I'll tell you then.
Well, yeah, everybody knows where I stand on that, but
yeah,
I think American Express and Costco really embody that. If you study those competitive advantages and how they have a virtuous cycle to them, to me, that's in my opinion. But yeah, you could probably have a short list of stocks where that's the case.
So it says, leaving the question of price aside, the best business to own is one that over an extended period can employ large amounts of incremental capital at very high rates of return. The worst business to own is one that must or will do the opposite. That is, consistently employ over greater amounts of capital at a very low rate of return. Unfortunately, the first type of business is very hard to find. Most high return businesses need relatively little capital. Shareholders of such a business usually will benefit if it pays out most of its earnings in dividends or makes significant stock repurchases. Again, this is from Buffett's 92 letter. So what are your thoughts on this quote?
It's really tough because it's a catch-22. And is Buffett sounding like a growth investor here? He's talking about reinvestment rates, right?
Mm-hmm.
And the reason why it's such a catch-22 and the reason why it's so difficult is because naturally, the natural life cycle of kind of an industry and a business, you get a bunch of competitors all kind of going at it, and then maybe you have one or two top dogs. And then as the kind of mature and the industry stabilizes and you kind of have the big players, once they've all kind of had their position, they don't need to necessarily be all scrappy and sacrifice profits like they used to. And so you get these maturing businesses, stable industry. And then so they're able to be more optimized for profit, as Brian Ferraldi calls it. But once that's the case, then they don't have anywhere else where they can grow. So it's like the things that give you all the profitability also take away that opportunity to grow. So it's such a dichotomy because in the chaos is the room for growth. But once the industry stabilizes, there's not a lot of moving around in positioning. And so you got all this money and nothing to do with it.
Yeah, right. It's a conundrum, right? It's like generating all this money, but it's not sure what it can do with it. And that can make it challenging. When I see this quote, one of the companies that comes to mind is Coca-Cola. And I was thinking about this the other day because you mentioned it when we were talking about what a brilliant business model Coca-Cola is. Most of us think I initially thought of Coke as like the super heavy industrial type of business because they sell syrup, right? And it's like that takes a lot of work to make those syrups, not only for the bottling, but also just the restaurant type things and all that kind of stuff. But in reality, they outsource all the heavy lifting and they do the lighter stuff. And so it's actually more of a capital light type of business than your initial reaction to looking at something like Coca-Cola. And when I read this quote from him, that's the company that kind of comes to mind. And I think that was this is a few years after he had made that big investment in Coca-Cola. And by this point, it's been turning out really well for him. And so I think that influenced his idea of trying to find these capital light type businesses that can generate high returns, not only on the capital that they invest, but also for shareholders. And I think that was one of the things that kind of started to maybe not turn around his thinking, but change his thinking on what kinds of businesses he really wants to own.
Yeah, totally. This was 1992. So he had owned Coke for like 5 years. Still kind of a newer owner.
Yeah, newer.
Yeah.
The last quote I wanted to share with everyone today, this is from a CNBC interview he did. The best thing that could happen would be if the stock did nothing for 5 years because they were going to buy in a lot of stock. People have the misconception when we buy a stock we like it to go up. That's the last thing that we want it to do. So how does this strike you?
Yeah. Man, I wish I could think this way. I know I should think this way because I buy a lot of stocks that do buybacks. And so the longer the stock stays flat, the better my buybacks do. But man, it's so hard. It is so hard because you want that validation to say, oh, I made a great decision. And the stock price clearly shows I made a great decision. But when it doesn't play out, I start to think, am I wrong?
Right.
Buffett doesn't seem to do that.
No, he doesn't. No. And that's it's so hard because you want the market to tell you that you are right. You want confirmation bias. And especially in the first, it's like dating, right? Like when you first know somebody, you want all this validation that you're making the right choice. And then after a while you get comfortable and that becomes less and less important. And I wonder if the same is when we invest in businesses. we want that validation that, all this work and effort and thought that I put into buying a particular company is going to pay off because the market is saying, see, look, Andrew and Dave were right. This was the right thing to buy. And as the stock goes up, then it just confirms, well, see how smart I am? What a great decision I made. This is awesome. But to Buffett's point, the more it doesn't, the more opportunity you get to buy more of this company. And the more it gets to reinvest in its own business by buying back shares, then that just creates more value for you as a shareholder. So ultimately, the long run, it has to go up at some point. But I think it's okay to see it not do great at first. And it's such a hard mental place to be. I'm not there.
Do you have moments of clarity though?
I have moments, like the fog lifts and you're like, it's okay for it's okay for this company to not do great because I know in the long run it will do great. Texas Instruments is a good example of that for me, where I believe in what the company is doing. I believe in their capital allocation. I believe in the management and what they're trying to do. And I've been okay with it not performing amazingly along the way because it's giving me more opportunities to buy a bigger slice of the pie. And when it does do well, which I think it will, and then I'll be a lot happier. But that's a rare case.
So how did you get there with Texas Instruments?
I think for me, it was probably two things. Confidence in what I had learned from you about the business, and confidence in what I had learned doing my own due diligence on the company. And I think combined with those two things, it just gave me a lot more confidence that, okay, clarity in management telling us what they're going to do and then actually doing it, even though it hasn't turned out exactly the way you'd like in the timeline that maybe we all want. I think the fact that they've been so forthright about what they're trying to do from the get-go also kind of stands out in a sea of not being like that. And so that also gives you a lot more confidence because it's a rare thing to see. And so I think that also helps it stand out to me anyway.
I'd be curious, and if there has been work done on this or academic studies or anything, please send them my way if you're out there. It's felt like a lot of the stocks in my portfolio, they'll go through like growth spurts and then they'll kind of just chill for a little while and then maybe go through a growth spurt again. And depending on when you buy a stock, you could be in one of those sideways periods or you could buy it right before that growth spurt. And obviously, I mean, the businesses, if you look at their earnings growth and everything, you don't really see that kind of growth spurt, the kind of thing. But for whatever reason, the stock price seems to be growth spurty. You hold a stock for 4 years, it doesn't do anything, you get the growth spurt. Now all of a sudden you're beating the market. And if you would have sold at year 4, you wouldn't have gotten all of that gain. I don't know. That could just be completely anecdotal, very emotionally driven, just my memory failing me kind of a thing. But it does feel like you get these growth spurts with these stocks. Because I've noticed when I'm doing victory laps in my head about the winners, whenever I do a victory lap, that's when the stock either goes flat or starts to decline a little bit. But then I forget about a stock, and once I've forgotten and I never think about it again, it hits a growth spurt. So it's like, why does it do it that way? And if that's the case, then maybe Buffett has experienced this multiple times, and that's why he says he prefers when it's in this kind of sideways market for a little while. Yeah. I don't know. Who knows?
Yeah, it's hard to know, but he's been investing for 60, 70 years, so he's probably seen a cycle or two. So he's probably got some experience with that he can lean on, that we have to kind of take from his teachings and try to learn from them as much as we can.
Yeah, I'm trying to practice it with a stock I bought earlier this year. We'll see how that goes. I'll tell you.
To be determined.
To be determined. It's much harder to hold something that's not a consumer-facing name when it's doing poorly. Like it's much easier to hold Apple than it is to hold like a materials company that's struggling.
Yes.
I'll just say that.
Yes, for sure. Yes, there's lots of different challenges, different companies, different industries, Yeah, it's all part of the learning process, right?
Has there been a stock where it did nothing for a long stretch, you sold it, and then it just immediately shoots up after?
I mean, I've had a few companies that I've owned that were sideways for a little while and then started to do well. Like I was on the verge of like, okay, maybe I made a mistake here. Uh, and then they started to do well. So, okay. But yeah, honestly, I don't really check on my exes. So when I sell something like when I sold Intel, I have no idea what it's done since I've sold it.
Yeah, nothing.
I'm just bitter about the breakup, but I have no idea if it's done well or not. So, all right, folks. Well, with that, we will go ahead and wrap up our conversation for today. I hope you enjoyed our reminiscence of Buffett's quotes, and hopefully you find them helpful as much as we have found them helpful. If you have not read his shareholder letters, I strongly encourage you to do that. It's a lot of pages, I'm not going to lie, but there is a wealth of wisdom in there, and you'll learn so much. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.